We're going to talk through about succession today. And we started with Frank. He's going to give us a little bit background information about who can invest through the SMSF, and also the real case he want to share with us with the family detailed financial situation and their goal and strategy, why we help them with this kind of strategy. And followed by myself talking about SMSF lending. A lot of people got confused how much we can borrow, what kind of LVR, and also what type of property loan we can do. Is it only commercial or like a residential? So I will get it clarified. And also giving you several examples about how much super contribution, how much you're able to borrow. And then followed by Julian. He's going to give us like a more detail about why a buyer agent take a key role for SMS strategy to be implemented. Because without finding a property, you can't really implement this strategy well. And also, Julian is going to share with us about 5 real case we have recently done about the property, where they find it, what is the purchase price, and what kind of rental yield, and also so far how much property equity they got increased. And also last session is we're talking about the hot topic is that the property market. For example, like WA, Victoria, Adelaide is really hot at the moment. Is that sustainable? What kind of trends is going to happen? So Julian will give us kind of insight information. And last session will be like a Q&A session. Actually, the Q&A is we pick up several questions from all the registered people. And we will follow by like Frank and Julian to help answer those questions. And that's about the agenda. Let's just move to the first session. So let Frank, to give us a little bit introduction about who is able to invest with SMSF.
These 4 questions are commonly asked questions. So for the past 2 years, we worked with a lot of self-managed super funds. And we have seen there's a huge surge in terms of people who are interested in setting up their own self-managed super fund and invest through a superannuation fund. There's a lot of questions initially, like what is exactly a self-managed super fund? I guess people joining today would already have some kind of idea what a self-managed super fund is. But if we look at, all our super accounts, a lot of people are having super money with, Australian Super, Host Plus, or Uni Super. So what are these super funds and what are self-managed super funds? Essentially, so in Australia, if you wanted to manage your own super money, you can use a self-managed super fund. But if you want other people to manage it for you, then you can use other super companies' super account to manage this investment. The biggest difference is when a lot of people setting up, they're not aware of the difference. The biggest difference is when you managing your own super money, you're taking full legal responsibilities for this money. What does that mean? So if the fund goes wrong, potentially you have the risk of getting the whole fund taxed at maximum 45%. So meaning if you have $1 million in your fund and by accident you messed it up and made some mistakes and breached their compliance requirement, it could come down to 650. It's going to 550K. So that means 45% is going to be taxed, which is something that nobody wants it to happen. So when you have your own super money, you bear the responsibility of making sure that you're getting it done right. And the second question we got asked a lot is how much money I need to be able to set up a self-managed super fund. In the past, the ATO tax office had a guideline of $500,000. But then since then, because of the technology and a lot of things making self-managed super fund a lot more cost effective to set it up and running it, ATO changed the guideline to 200K. So usually to make it worth the effort and the cost to run your own fund, you need to have about 200K. But then the question is around, is it for the whole family? Is it just for myself? Absolutely. When you set it up, a self-managed super fund can have a maximum 6 members. In the past, it was 4 members. So 6 members meaning you can have your parents, yourself, your spouse, and your kids in the same fund. You can have people in a different life stage in the same fund. So you can pool all the money together You just need to make sure that you have the minimum balance of 200K. That's from the tax office guideline. So a lot of people ask, how do I open a self-managed super fund? Do I just, go online, find like a eSuper or DIY super, just, put my details and click it through, and then I can open my super fund? Absolutely, you can do that online. There are facilities to allow you to open fund at a relatively cheap cost. You can contact an accountant to open a self-managed super fund. Obviously, the accountant will be able to set up everything for you. But the question really is, should you have a self-managed super fund? I think nobody is able to answer that question for you unless you understand how self-managed super fund operates. A lot of people open a self-managed super fund simply because they want to buy US shares. But be honest, you don't necessarily need to have a self-managed super fund. You can trade shares with a super company who has these kind of facilities to allow you to trade. So when you open a super fund, the question is it the right thing for you? That comes to the fourth question. Is it the right choice? I often ask people why you wanted to have a super fund, your own super. What's the point? Like what exactly you wanted to achieve? Probably 80 to 90% of the time, they say, oh, I have no idea. I just don't like my current super. I don't see it performing. I think we need to dig it down a little bit deeper. How the super is playing in your overall financial structure. Same like your own family trust, like your own company, like your own share portfolio, how these assets are playing in your own financial structure. You need to understand the role. And you need to understand when you open the self-managed super fund, how you're going to manage it, how you're going to invest it, who's going to put in the money, and what it's going to look like in another 5, 10, and 20 years' time. A lot of people came to me and said, look, Frank, I just want to buy a property. Then there's a whole bunch of questions that we need to ask. What kind of property you want to buy? How many properties you want to buy? And have you ever considered diversification for a lot of other things? Once we address each and every single one of these questions and have our own answers, then we know is it the right choice. So it's not simply just go online and click or contact an accountant to open an account. It's more or less of understanding why am I doing this? So for the past 2 years, we opened a lot of self-managed super funds for our clients, designed a lot of strategies. At the same time, we also help the client to close self-managed super fund accounts because they find they have no strategy for it. They find it just too much of administrative work. So in that kind of situation, we need to ask why we open it in the first place. And another thing is quite interesting. Is the accountant able to recommend a client to open a self-managed super fund? The answer is no. A lot of people are saying, my accountant just asked me to open a self-managed super fund. The accountant is not actually in a position to advise you when you should use a self-managed super fund because it is a financial product. It needs to be distributed with a licensed advisor. So that's a very important thing that you need to understand. But if you insist you want to open it, the accountant could not stop you. So that's what we see a lot. Oftentimes, people come to the accountant, open a self-managed super fund, and then have no idea what to do next. So if we come to the next slide, when it comes to the self-managed super fund, there are a whole lot of risk that associated with the self-managed super fund. As I said, there can be tax issues that you never realize. So I remember about 6 months ago, I met a client. She created a self-managed super fund by the accountant and then talked to the mortgage broker, purchased the property. And what happened is she just, rented the property to her mother to live in the property. And when I was sitting down and heard the whole story, I was thinking that's crazy. Almost everyone knows that you cannot have anyone you related to live in the property that you purchased throughout your self-managed super fund. But then she said, oh, nobody told me about that. And then I realized, okay, the accountant thought she understand the rules. And the mortgage broker thought she understand the rules. And she thought that everyone should tell me what I should do. Then it comes to a situation where, nobody is telling anybody what is the right thing to do. So there are a lot of risks that happens in managing your self-managed super fund. Another thing that we often see is when the accountants open the account and roll over your existing accounts, all the insurance is gone. Maybe there is only 100K in the balance, but there are 500,000 insurance in there, and nobody addressed the insurance issues. In reality, when we look at a super account, if there's only 100K in balance and there's a 500,000 insurance there, in reality, if someone dies, that's about 600K value of that super. It's not 100K. And there's a whole lot of risk of not having insurance when you set up a self-managed super and not consider the risk of doing that. So we see these happen almost every day when they're not considering what is the right way of setting up the self-managed super fund and what is the right way to do it. So you need to have the right knowledge to understand, or at least you need to know that where is the source to find all these answers for these questions. If we come down to the next one, I want to just to introduce you to a couple of cases that we helped our client. So recently, this is just one of the clients that we helped. So recently we came across very similar situations. People came to me and said, look, Frank, I have about, 500K, my wife at 250 and then myself at 250, we'll put it together 500K. That is way above way above the 200K that you mentioned. And we already have our investment properties and, 3 investment properties. So based on our income, we already borrowed to the maximum amount that we can borrow, but we still wanted to invest because all the previous investment properties that we purchased are all in Sydney. These are very expensive properties, and that pretty much used all our borrowing capacity. But we have seen properties that in other states that potentially would have better growth potential and also income. So when we're sitting down and talk about this, we often ask the question is, what exactly is your property investment strategy? So obviously Julian would go in detail in terms of what the strategy can be. But we often sit down and talk to the client, do you have a strategy in place? Are you aiming for the capital growth or are you aiming for the income? And what exactly is your exit strategy? Do you want to just buy and hold? Or do you want to buy, maybe to flip, or maybe, to sell 1 or 2 properties and realize the profit and then pay down all the debt? We find out pretty much 99% of the time, nobody would have any idea what they were doing with their properties. Why? Simply because one of their investment properties are most likely their first home. And then they upgraded to the second home, then naturally the first home became their first investment properties. And very naturally, the second or the third property will probably be the houses or apartments around their first home. So we can see that happen a lot. So when we sit down and look at how we really trade our investment strategies, we need to understand what exactly we're aiming. We find out inside superannuation, if we're chasing for capital growth, it's going to be pretty difficult because you're going to see a situation where you purchase a property and you borrow a certain amount of money, and then the rent is not enough to cover all the interest. Then that just means you're going to have to use all your super contribution from your income to pay for whatever the shortfall would be inside your superannuation. And that comes down to a risk where what if there's a redundancy and you all of a sudden you lost your job? What if there's an injury happen to you and then, or medical condition happen to you, then you would no longer be able to contribute to your super. So there are situations where there's no income, and then you won't be able to continue to pay down the debt inside the superannuation for that particular property. And when that happens, that just means the only way is to sell your property. Obviously, we have other risk measures, including insurance to cover that. But that's the situation that we don't want our clients to be in. And we realize that superannuation is best for their tax and also is best for, holding it for long term to manage the cash flow. So if we design something that is, cash flow positive or at least neutral, or at least with very little of negative cash flow for clients to hold the properties inside their superannuation, then doesn't matter what the interest rate goes up or down, they have less pressure, or they don't really need to worry about what's happening with the property inside super. So with this client with 400K income, 3 investment properties, 500K in super, we're sitting down and discuss what are the ways that we can do. Then we decided that they're actually wanting to look at in other states for example, like in Queensland or in WA, because this one was happening a lot earlier before the WA actually went up like crazy. So we looked into WA and we set a budget for about 500K to 600K and only used a portion of what's inside super and borrowed about 70% for that particular property and have a neutral cash flow that allowed the client to see the growth and the cash flow of that property, have the rest of the money ready, that they have already experienced the first property to decide if they want to actually use the rest of the money for the second property. So what happened is within 12 months time, the client is able to purchase 2 properties with a combined value close to $1.1 million and is still cash flow neutral. So that's one of the case that we've seen. And a lot of people ask the question is, okay, we have 500K in Australian super, and it gives us average about 8.5% investment return. And what's the benefit of investing into properties and in the remote area and maybe only gives us 5-6% growth? The benefit really is to have a certain level of leverage to that property that we're able to leverage for a bigger asset. And once the rent is paying down the debt, it's going to have that kind of accelerating effect where the debts, when you have a positive cash flow, based on our projection, the debts actually can be cleared within about 18 years time instead of 30 years. Obviously, the loan term is about 30 years, but the debt can be cleared in about 18 years. What that means is by the time of that 18 years past, you're going to have 2 properties that pump in positive cash flow in there for you without you even working for another day. And when the rent comes, we estimate to be about 60 to 80K a year, that allow you to do a whole lot of other things. For example, you can put it into shares or into other diversified investment, or even to purchase a third property. Because when we look at the self-managed super fund, the only income is either your super contribution or your rental income. So if we're only relying on super contribution, obviously William will go into detail in terms of how much we can borrow. If we only rely on super contribution, there's only that amount of loan that we can borrow. But if you have extra incomes from your investment properties and other investment, that means your borrowing capacity might be different, and that potentially would allow you to snowballing into purchasing more properties inside superannuation. So that's one of the client that we worked with. The next client is in a very similar situation with a really good income, family income, but no investment properties with a really good super balance in there. So when we we're sitting down with the client and discuss, okay, the client comes to me and says, look, I have a home, but I have no investment properties. I have decent amount of balance in super. I have some cash savings. Where should I start? Should I buy in my own name, or should I come into super, use my super money to buy it? That question often comes down to what kind of age the client is in. If the client is approaching retirement, let's say in about 20 years time, so that system is between 40 to 45. If the client is in that kind of age group, then superannuation would definitely be a better solution, because by the time the debt is cleared, it's about the time that they retire, between 60 to 65. And also with superannuation, that allows them to start different strategies. With good income, they can aim for high capital growth properties in their own name or in a family trust, or with the super, then they can aim for the yield. So they can actually work with both legs. One aim for the capital growth and one aim for the yield. With the capital growth, they can have negative gearing effect. With the yield, they can have the tax benefit along the way. So these are the clients that we worked with, and with our strategies, potentially we would be able to build up this financial structure. But yes, everything is like architectural drawings. How do we really implement this? It comes down to, first of all, how we design these loans. It's important how these loans work with their own investment properties, existing ones in their own names, and also how they're able to borrow money inside super for the first and the second and the third property. We actually need to see that happening before they even purchase the first one. Then the biggest question comes down to, we probably only make 1 or 2 buying decisions in our lifetime inside super. how can we make sure this property will definitely bring what we wanted to bring? For example, the growth, the yield, that comes down to the expertise in this field. And obviously Julian would go into detail. So how we really work together is we realize some advisors are really just there to talk and say, look, it's a good time, you have balance, you set it up and let it run. But what we really wanted to do is we wanted to see that happen. We wanted to see the drawings, but then we wanted to see the completed outcome. That's the reason why we actually put everyone in the same team together, from a drawing to final completion. And that would guarantee this kind of outcome for our clients. I'll share for this much. I mean, like, there's a lot of information already. I hand it over to William to talk about the lending side.
Cool. All right. Yeah. So for the lending part, everyone mostly interest part is about how much are we able to borrow. So this come up with several other questions. But before we go into that, let me just give you a little bit summary information about SMSF environment. So first of all, we definitely able to do both residential and commercial under SMSF. And if you go to look at the table, and the interest rate is slightly higher than the personal environment. So residential SMSF rate is starting from 6.79, but in personal environment, it could be like just around 6%. So it's slightly higher, as well as the commercial is also starting from 7.69. As for the LVR, just to surprise everyone, in residential world, we can borrow up to 90% LVR, but no one doing that because we need to have a financial advice. Is that risky or kind of cash flow pressure? Those things. So that's why normally, generally speaking, the best practice could be considered as a 70% LVR and even lower. And for commercial, we can also maximum borrow at 80% LVR. And as for the maximum long term, it can be same as in the individual environment. 30 years term is a maximum term. And also surprise everyone, we are also able to do refinance, during this kind of SMSF environment. However, the only thing we need to be careful about is we are not able to do any equity cash out. So dollar to dollar refinance is the one we only be acceptable and it's compliant. So for example, you have a property about 1 million. When you buy it, you borrow at 800,000, but after 10 years, the loan paying down to 600,000. And you want to do leverage the equity already paid down, and you want to using that equity, to borrow the next property, you can't do that. So you will only able to dollar refinance, not able to do any equity cash out. So, but sometimes we're still able to do, dollar to dollar. The reason is in the old days, all the major banks can do SMSF, but about 4 years ago, they pull out. They feel this is too risky, too much costs, and not making money. So that's why it's only a non-bank lender is doing the SMSF lending. So for those customers who are still with a St. George or Macquarie or maybe Bank of Queensland, the interest rate could be goes up to 8 point something at the moment for residential SMSF rate. So that's why we can do refinance, lower the rate to maybe 6.79 or 6.99, depends on the LVR information. So that's the way we look at whether we need to do the refinance or not. And also for the maximum loan size, for residential side, it's up to 5 million, and for commercial, it's up to 8 million. So quite flexible, and there's a lot of things we can do under SMSF, honest to say. Talking about what kind of element it might impact your borrowing power, I list down this kind of 6. I go through it one by one. So first of all, is major, considerations about super contribution. How much you contribute to the super. It depends on whether you are PYG, the employer paying you 11.5, or you're a self-employed customer and you do the super contribution by yourself on an annual basis. They'll all be able to accept. However, for self-employed customer, if you are not doing regular contribution, then you will probably in trouble, because most of the lender will look at last 2 financial year as a frequency or a pattern, and they will use the average contribution figure for the income assess how much you're able to borrow. So that's why for self-employed customer, it's we need to well prepare. starting to do like a maximum or certain amount of super contribution. We can't say I want to do it tomorrow, but in the last 2 years, I haven't done any super contribution. You're definitely not able to do that. So this is first thing. But good news from the lender perspective, they are also creative. They understand some customer based on their employers 11.5%, or maybe self-employed customer last 2 financial years contribution is not something can satisfy them. So they introduce a concept called we can using your forecast super contribution amount for assessing the loan and borrowing amount. The rule behind is they can assess your taxable income in the last 2 financial year. And based on the taxable income, they can maximum take 20%, consider as a forecast super contribution amount, and use that amount for servicing how much you're able to borrow. So this policy is typically for like a self-employed customer. So, and for like a PYG customer, then they might able to just taking your 10% of your gross taxable income and add on to the 11.5 employer contribution and can consider as the valid income for super borrowing. So this is the first one. Second one is about the rental income. So obviously, if you buy something have a high yield, 6%, or even commercial property, right, then it will help you to bring up your borrowing power. So this is also the most important thing. The third one is about the super balance. So it will impact how much the property price you're going to purchase. It won't increase in your borrowing power. So for example, your borrowing power based on your super contribution, the rental income is, let's say, 800,000. But if you have 300,000 super balance, potentially can achieve buying something 1.05. But if you have 500,000 super balance, then you can aim higher. So super balance is like individual environment fund to complete, the same concept as a fund to complete. It depends on how much property price you're able to buy, and also rely on your borrowing power. And the fourth one, similar to individual environments, everyone will access your living expense, right? But in super environment, there's no such kind of living expense need to be measured. The only measurement is for the SMSF running expense. So normally it would depend on rely on accountant letter to clarify, okay, I certify this customer's ongoing SMSF running expense is about 2,000, then you will take 2,000 as the running expense, similar to living expense. But if accounts say, I have to declare as a 3,000, then potentially impact a little bit your borrowing power, because by comparing to 2,000, you will have to spend extra 1,000 each month, each year, sorry. So, and the last one is about SMS interest rate. So similar to individual environment, interest rate is related to your assessment rate. So in the individual environment, the actual rate, the bank will put additional 3% as the assessment rate, buffer rate. Use it as an assessment rate. But in SMSF environment, this buffer rate is only 2%. So basically, your actual interest rate plus 2%, they will use it as an assessment rate to assess how much you're able to borrow. So you will be finding out if we're talking about commercial SMSF loan, because the interest rate higher, then it will limit your borrowing power. But on the other side, because it's a commercial property, the rental income will still higher than the normal residential property. So it's like a kind of offset, So the last one is about the age. So age behind the concept is about the long term. Although we can do maximum 30 years term, but actually how much long term you're able to get, this depends on your age. So for example, most of the lender will assess your current age until 80 years old. For example, if you're 45 years old now, you definitely can do 30 years term, because there's 35 years to run until you become age 80. But if you're like 55 years old, then there's only like 25 years left before you get into 80. So that's why at that kind of situation, you're able to get 25 years long term. So as you know, the shortest long term, then less borrowing power, because they will calculate the monthly repayment based on how much long term you're able to get. So that's all these 6 elements which will impact your total SMS borrowing power. All right, so this is the last slide I'm going to present to you. I have done a very accurate calculation recently based on how much super contribution you can do as a combined, for example, husband and wife combined super contribution, and based on how much rental income you can potentially get from this kind of a property, and end up with how much you're able to borrow. So if you look at the bottom line is, if you do only one member in the super and your annual contribution is 20,000, based on the rental income 550 per week, you're able to borrow about 380,000, not too much. But if you double it, 40,000 contribution, let's say you can buy something more expensive and the rental income increase to 650 per week, then you're able to borrow 620,000, almost a double. And the reason I put 60,000 as a super contribution for the top line is because, as you know, from this financial year, each person's concessional contribution is 30,000. So if we combine two members together, 60,000 is the maximum one you potentially can do, then you can potentially borrow 850,000. And this is based on the rental income is 750. All right. So 850,000 plus your super total balance, that's the potential property price you are able to achieve through the super environment. So that's all from my side. I would like to pass on to Julian, give us a little bit more detail into what kind of strategy he's going to use for helping the customer find the right property.
Thank you, William. So what I thought I'd start with is talk about how at Search Party Property we build the strategy. It's a word you've heard a lot today between the two of us, and then how we then start identifying properties and build portfolios for our clients. So these are just six of the key reasons why people have worked with us and come back to us and I guess partner us like Frank and William. Probably the key one for me is to develop the informed strategy. So when we're working with Frank and the team at XIN, we get a lead that comes across that's already had their financial plan laid out. They understand their finances. William's given a very clear indication on what they can borrow, what type of rent they need to do, what type of yield we need to produce, and we build a strategy from there. So a lot of the times these clients, when buying in super funds, won't really have an idea where to buy, what to buy. Sometimes they're thinking we can only buy in Sydney because we live in Sydney. Some will come with preconceived ideas that we can only buy a high-rise apartment, which again, potentially could get good yield, but as a long-term investment, it's a very poor investment due to strata cost and other expenses can come in. So we work with them, we understand their buying risk appetite, what is their background in investing, what other assets have they got, to understand their mindset, which is the key for us on understanding and building portfolios for our clients. So strategy is key. When a client comes in, we do the strategy session, normally at least an hour and a half. We then write back to them with the full minutes of that meeting. And then we produce a buying brief, which comes through the back end of that session. So we're all very, very crystal clear on what we're buying, where we're buying, and what type of property we're buying. So some clients will come to us with the lens that they might want a shiny new home. Now, I'm not suggesting a house and land package or anything like that, but something that might be a few years old. So there's still some benefits in a newer home, but also not having any issues with repairs and maintenance, which can for a super fund can really cause issues around their cash flow if we're having to repair and maintain an older home. So we're generally looking for properties which have a good condition and not going to cause too much stress for our clients. Once we move on from there, I guess some of the other rationale or reasons that we're getting for our clients, negotiating is a big deal. The average Australian, not investor, the average Australian buys 3 properties in their lifetime. So that suggests to us that negotiating isn't a strong trait, a natural trait that Australian investors have. So when we're negotiating on dozens of deals every single day of the year, and we do that now for 6 years, I've been investing for 20 years, but as a business, we are investing on negotiating on dozens of deals per day, which means we're not buying every deal. We're negotiating. If it goes over price, we walk away. It's about picking the exact right property and investment for our clients. Team on the ground is probably another differentiator for us. One of the things we are very, very clear on is that we have our own team inspecting properties, talking to the agents, building rapport. So in Sydney, Melbourne, Brisbane, and Perth, every property we bought in these areas, in these regions, are our own team. And why I've insisted on that as a part of our business strategy. Costs us a lot more to run our business, but we can put our hand on our heart to know every property we've ever sold has been inspected by one of our team. We're not relying on the selling agent. I think one of the biggest myths of Australian real estate is the selling agent works for both parties. The selling agent only gets paid by the seller. And so their full responsibility and their full attention will always be to the seller, not to the buyer. And so that's where the buyer's agent come in to be the advocate and only focus, and we only work for the buyer. We have no relationship with the selling agent or the seller. We are paid by the buyer, and hence we have full responsibility for the buyer. I guess time's a big one. You saw some of the case studies that Frank showed, some of the cases that I'll go through. Most of our clients, the persona ideal client or persona client for us is husband and wife with 2 kids, generally busy, both working, or at least one of them working, and busy professionals with a lot of activities with children, and so they just don't have the time. So unless you're going to buy in your own backyard, even that's difficult to go to auctions every weekend, understand where to buy, and that's probably another trap that we see with most investors. They generally buy very poorly with their first investment, which stunts their growth for long term. So poorly to me would be buying a high-rise apartment. Once you buy something like that, from an equity gain perspective, it's very, very rare to get a high equity gain, which means you can't roll on and buy property. Now in super, it's a bit of a different story because we're not using equity to build portfolios, but outside of super, it's very important we get the right asset class. So having that team on the ground really helps us know the market, we know the streets, we know the agents, and gets us activity and opportunity to get pre-market or off-market deals, which necessarily doesn't mean it's a great deal or the best deal. It just means we get access to it early. And in hotter markets, what we might use the term hot, like a Perth at the moment, that can help us get to the market before an auction, because we rarely want to go to an auction. We want to be unemotional. Our whole focus is on the commercial modeling of what we're buying. We do not want to be bidding in an auction to push the price up. We leave that to the home occupiers because that's an emotional purchase. In investing, we're very clear on the numbers. Frank's given us complete numbers. We've produced full 10-year cash flows for all our clients before we go to the buying stage. And so we're really clear on the numbers we have to achieve. Data is a big aspect for us. How do we know where to buy and what to buy is by using our methodology around data. So the couple of the logos at the top there, you'll see companies like HTAG, Suburbs Trends. There's a top one there called DSR, Matusik. These are all Australian software companies. They're pulling open source data and code from a lot of open platforms like RP Data, Australian View Statistics, realestate.com, and they're building algorithms around property. And what we do is we're paying, I think last year I paid $22,000 in subscriptions just to data platforms for us to just give us that head start. So I'm not such, the funnel approach is saying that's one of the top line approaches. We're analyzing data constantly. We have a full-time economist in our business called named Nathan, and his job is to run through data, and we're looking at areas to buy. So how did we know to buy in Perth 3 years ago, long before the peak and the boom started? Because data showed us that. We've read through the Western Australian government reports. We understood there's a huge development happening in Rockingham around the Navy redevelopment. So we went there, I spent a week there, traveled up and down to Perth, and we started a business in Perth. We're very keen now on Melbourne. We're seeing what's happening in the Melbourne market, and that puts us into those areas. A couple of case studies now to run through. So as I said, Frank will bring us these clients. We go through this whole strategy with them around the buying side, and we end up in the buying. And these are just some people I wanted to talk through. So Michelle, she came to us, single lady, planning for retirement long term, but just wanted to get a property in her portfolio in a super fund. This is a relatively new property you can see, good sized land in Logan, which is south of Brisbane. Again, her mindset was she didn't want something old. So this is a house here under 10 years of age, no repairs and maintenance, which is not going to have any sort of impact on her regular cash flow. So 3 bedrooms, 2 bathrooms, 1 garage. We bought that. You can see there the date, August 23. So exactly a year ago, for 540. The current rent on that is 520 per week. So her gross yield is just over 5%. And the valuation on that, which we did last week, is $650,000. So she has made an impact of 22% in one year on that property. So that's a great growth, and that's about building. So now she's going to be able to keep rolling and build her portfolio from there. Eric and Ying, again, a younger couple is just looking to take advantage within their super fund and start building a portfolio inside super and outside super. So again, we needed to look for something a little bit newer. This is a smaller parcel of land, but in Western Australia, Perth, which we're seeing great growth and great opportunity for us to get clients. So Perth had a very different mix. Obviously, it's a city which has got a lot of land available because a lot of people are living on the coast. But they started building these new developments, but they cut them up in very small pieces of land. A bit like what's happening in say the northwest, way out west, northwest of Sydney, say Box Hill areas like that. But yet these properties still do very well from a growth perspective. So again, we bought that for $400,000 again in September 23, $560 per week rent. And that's now valued at around $560. So again, a 29% growth in 1 year. So these, you could say, a little bit of luck in buying the right time in the right place, yes, but you have to take action. And if you don't take action, you don't have time in the market, you're not going to be able to produce results for yourself long term. A couple more, Graham and Lorna, again, this is a little bit older property. They want a little bit bigger block of land. We're also looking at an area of Baldivis, which is in that Rockinghamshire, the shire I mentioned with the $5 billion Navy redevelopment. And this shire has done so well. We bought hundreds of properties in that shire alone in the last couple of years. So again, you can see there 32% increase in 1 year with, again, strong yield to help them manage the cash on that property. And Vikram and Brinda finally, again, wanting to build their self-managed super fund assets. Both of them have very good jobs. Frank worked with them on how they can build a longer term play for them through property and their other investment classes. With them, we're looking at something a little bit bigger, a bigger parcel of land. We definitely wanted a 4-bedroom home, and we're looking for a stronger yield. So you can see this one is closer to 6%. Again, a $500,000 asset. So this isn't property investing isn't for people who are billionaires or earning $1 million. This is, you know, a husband and wife on good incomes and using their super fund to build portfolios. And again, got into the market. They took our advice. They were a little bit nervous. They thought they had to buy in Sydney or buy an apartment in Sydney for $500,000 because that's where they lived. But they understood we managed the entire process. We got a full 360-degree service levels for them for even post-transaction. We're always with our client checking in on the property management, doing annual reviews and reports, very much like Frank would do for his financial planning clients. And again, another 30% a reward for them. And last one, Luton John. So Burp & Gary, which is in Moreton Bay. Again, a relative new house, under 10 years of age, very good rent. You can see there in yield over 6%. And again, within a year, they've already achieved a 12% increase in that property, which is, you know, double the national average. So obviously, I think we got blown away looking at those last year in Perth for around 30%. 12% is a very, very strong gain in Australian real estate. I'm now just going to talk through and look at different housing markets and why do we buy in certain areas? How do we analyze data to then review different states? So today I'm just going to take you through our analysis of different areas in Australia and the key buying areas we're buying and why are we buying in certain areas. Not every one of us should be buying in a particular city. It's really going to be based on our budgets, on our strategy, cash flow. Some of our clients like to do developments, but you can't do that within super. So it's all about looking at what we can do. This is a fascinating graph here. It's one of my favorites. If we work down from the top, we can see, look what happened in Perth. You know, we had some booms and in the 80s, 9% growth, then relatively stable at 5%, and then another big boom for about 8 years in 2000 and 2010. And then for 10 years, 1.3% growth. So what we call the boom and bust of the Perth market, the mining town. But then again, we saw in 2023, 17.3%. Some of the areas we bought in last year, as you could see, those case studies increased 30%. A place called Mandurah was the highest increasing city in Australia last year at over 30%. The fascinating part about this graph is actually just looking at that every state, every city on that graph has relatively had peaks and troughs for around the same time throughout that 40-year period. There's no one standing out for me to, a lot of people say Sydney, you must buy in Sydney, it's a premier city of the country. Yeah, it's true, but there's nothing in that graph there that says Sydney far outweighs any other city in Australia. Sydney over that time has made a 7.59% increase, Canberra at 7.5%, Brisbane 7.35%, Melbourne 7.35%. Look at Melbourne's chart. For almost 20 years, they made 8.4% growth. But everyone sort of says, oh, Melbourne's now got a place to invest because it's gone negative 7% in the last couple of years. So don't invest in Melbourne. In fact, that's the opposite of what we're doing. We're doubling down in Melbourne. We're investing heavily in Melbourne because we want to be buying in the dip of the market, just like you would in the share market. Look at the reason. Why did we go to Perth in 2022? That would be a crazy thing to do. 1.3% growth for 10 years, and we went and opened up a business in Perth, because the data showed us that Perth was the place for us to invest for our clients over the next few years. And that's to continue on there. So I think that chart, what I wanted to show was that there's markets within markets. Every city will move at different times. And the most important thing in property investing is having time in the market, taking action, building a team of experts, and having time in the market. And there's a few bumps along the way sometimes, as you can see in those charts, but it's a great long-term asset. So I'll just run through each of the key cities that we're investing just quickly. Obviously, we can assist you with sharing this information as well. So Brisbane, we love. We've been buying there heavily for at least 6 years now. Strong population growth. A lot of that growth came from international migration, particularly after COVID, when I think 70 or 80,000 Victorians fled their city and ran up to the Gold Coast and Brisbane. Still very tight vacancy rates. Don't buy in Brisbane because of the Olympics. Definitely don't do that, but buy because of the government infrastructure. So if you're going to Brisbane recently, you'll see cranes all the way through the skies. There's tunnels, there's railway lines, there's metros getting built. It's the infrastructure why Brisbane has been so strong, and why I really believe it's got a lot of long-term growth to go. And it's really the evolution of Brisbane. I mean, only 5 or 10 years ago, you couldn't get a coffee after 3 o'clock in Brisbane, but it's really gentrified, and it's a really great, vibrant city. These are just some quick vacancy charts. Another one of the data points of 30 odd data points that we review why we like the Brisbane market. You can see the charts over the years, starting at 2005, and now we're up 2025. It's a 20-year graph, and you can see how tight. If we look at the data going down, you can see how tight and how much that has dropped the vacancy rate. So why do we like low vacancy rates? That means people wanting to live in an area, or in that situation, live in a city, and that brings competition, lack of stock, more people wanting to move in, and generally that brings price growth or rental demand growth, which is definitely, we're seeing that in most cities in Australia, but Brisbane has really got a shortage. Perth market, different types of migration. So one of the largest cities in Australia for migration. They're going for the student market. So they built a university and they're going heavily for the student market, because they're not going to be able to compete with Sydney and Melbourne for the higher end migrants with money and education. So they're going for the student market, and they'll continue on. Was one of the most affordable cities. It's probably now jumped up a few ranks there. Ultra low employment. There's still, I think someone said to me the other day, 20,000 jobs available in the mining industry alone. So they're just crying out for jobs. So when there's jobs, there's opportunity, and people want to come into a city. And that's a great, another one of the many, many metrics we're looking for. A very tight housing market supply. So still, they can't build fast enough. They just don't have the capacity and the labour force in WA to build fast enough. So that creates a tight market, which means prices are rising because people are paying extra to get into the market. And great infrastructure spend, actually. One of the beautiful things I noticed when I was there was, they're building these new estates in the north of Perth, about 30 k's from Perth, but they've built a 6-lane freeway and a railway line down the middle of it. So such long-term planning, as opposed to, say, an older city like Sydney, where we have to build tunnels everywhere and charge people lots of money to use the tollways. So yeah, it's a very well thought out city, being a younger city. And again, this is a little bit of a colourful chart, but what we're looking at here is property listings. And we can see here in what's happened in Perth, that blue, light blue, under 30 days, it says there, that's showing us that the Perth market, the properties aren't staying on the market for a very long time. Another indicator of data that I want to show you that we look at, if we can see time on market is getting very low, it's proving that the demand is there for property in this city. The Melbourne market, so probably a bit of a favourite of mine at the moment. So great migration growth. As we know, Melbourne's going to be one of the largest cities by population, I think 3032, so not that far away due to the migration coming in. Even though people are moving out, it's still a great city because of jobs. Lots of employment, as we know, lots of head offices in Sydney, huge government spend on infrastructure. So again, they've just released new roads, new tunnels, building up some airport runs as well. Improving affordability, I guess, as Brisbane, Perth, Adelaide have jumped to Melbourne now, as they've got a higher average housing rate than Melbourne, which is unbelievable to think. Our second most populated city has been jumped by these smaller cities, particularly Adelaide, which is mind-blowing to believe that Adelaide is more expensive than Melbourne. So another reason why I'm very bullish about Melbourne coming out of this trough and taking off as being, probably the city we're all going to talk about in the next 12 months. And the market here, this is just another forecasting to show the average annual growth. So we can see this is going forecasting year on year on year. And if we look at 2026, for example, from a population, you can see Melbourne is very close. Victoria is very close to New South Wales. But once we hit into the 30s, we will see Victoria jump because of the average growth of 1.37. So it'd be one of our most populated states in the country. And I think finally, Adelaide market. I've always called Adelaide a bit of a sleepy city. I've always felt it's a regional sort of category 2 city, being pumped up a lot by whichever political parties in power. A lot of government jobs have been migrated into Adelaide, but this huge submarine project there is brought a lot of jobs to Adelaide, which is exciting. On the other side of the coin, people say if American politics, if Trump comes into power, that could have an effect on that submarine project as well. But you can't predict the future, so you've got to play what we have in front of us. But it's been a wonderful city for investing. Not a city that we've put a lot of people in. We were really more focused and bullish on the cities of Brisbane and Perth over the same time, and Adelaide was taking off. So, but it did very well for clients who bought property in there. And again, just pure and simple, you can see the vacancy rate. You can see how vacancy rates were up around 2% for such a long time, for decades, in fact. And then we see this big drop happening, particularly on the back of COVID. So you see 2021, we just saw this drop in vacancy rates, and then we saw the uptick in the property market in Adelaide. Again, look at that the light blue, under 30 days. We can see the surge in under 30 days. So again, proving that the last 3 years, 22 to 24, or 2 years, a very, very vibrant market, and stock on market is going very fast, and that competition drives price growth.
Cool. So I think, we just come to the last part about the our question and answer. So we're collecting all these kind of typical questions from all the register, and then now just maybe starting from this one. I believe this is a question for Julian. How to find a property which is suitable for SMSF investments? Julian, please.
Yeah, I guess it goes back to the start of when I discussed, looking at the key strategy on what budget's going to be key, what sort of cash flow we need to do based on the finance that Williams brought to you. We then work through that and then start looking at the market. So if we're looking at a higher cash flow, we'd have to maybe look a little bit further out for a market. It might be Perth, it might be Brisbane. So really, it's not about looking at the strategy and then aligning that to what's happening in each of the cities and putting that together. And then we go through the whole formula of looking at the data points, full due diligence reports on every property, and then we're able to make offers and buy property for our clients.
Cool. Thank you, Julian. Second question is regarding to Is it necessary to seeking for financial planner services, or we can just rely on SMSF administrator when establish a SMSF? And also a follow-up question is about what is the total cost might be involved to starting with the SMF strategy? Pass it to Frank.
Well, you just is it necessary? Like to me, because I'm a financial advisor, I would always say it's necessary, right? So it's the same like the reason why not a lot of people seeking advice of using self-managed super fund is simply because they probably don't know what they need to know. That's the problem, that you don't know what you need. You don't need to know. There are things around, for example, how you making sure that you have, everything in terms of simplest, in terms of record keeping, then maybe how you establish your investment strategy, then it gets down to your risk protection, then gets down to your how you set up your beneficiary, then gets down to how you transition to a retirement stage. So at every single point, you might need to seek advice to understand what's the next step. But a lot of people not doing it is simply because it's just so easy to set it up. So is it necessary to seek advice to establish a self-managed super fund? I would always say yes, but a lot of people are not doing it. That's the reality. And another thing is people don't know why they need to seek advice. It's simply because they don't know what they don't know. I think it's important to understand why you need to do this. What's the strategy? Like, what's the motivation? And can this be achieved by other means without using a self-managed super fund? That's the first question to ask. And in terms of the cost, it varies from, getting an accountant to do it or do it online, or having an advisor to do the whole thing for you. So obviously, there are cheaper ways, varies from a few $100s to a few $1,000s. It really depends on what kind of service that you wanted to get in terms of what the strategy and what you wanted to achieve.
Okay. Yep. All right, and this is regarding the exit strategy. So people might think it's quite easy to buy.
Yeah.
But at the end of the day, when they get into the retirement age, so what is the exit strategy? So it's followed by 3 questions. So can I take back SMSF property into my personal self-living environment at the end of the day, or can I sell my SMSF property at any of the time? What kind of consequence and tax involvement? And also after the retirement age, then what is the cost? Do I change it back to my personal title or whatever? So can you please help to clarify?
Yeah. So can you take your self-managed super fund property to live inside your self-managed super fund property? So when the property is still inside your self-managed super fund, obviously you can't live in there, or any of your related party cannot live in there. But we need to understand what a self-managed super fund is. Self-managed super fund is simply just a container that has a certain rules that hold these assets for you until that you are able to take this asset out. We always say that you yourself and the members are the underlying beneficiaries. So that means you actually own these assets simply because you can't access them right now. And the only way to have these assets is using a self-managed super fund. So can you actually use this to live in there once you retired and you are able to access all these assets inside your self-managed super fund? Obviously, you can transfer the property back to your own name and live in there. So there's no problem for that. So that comes down to the second question. Can I sell my self-managed super fund property? Absolutely, you can sell it anytime. So if you do it before your retirement, so when I say retirement, it's either 60, you declare retirement, or you are age 65, doesn't matter if you're retired or not, you can sell it before retirement. Over 12 months, that's 10% capital gain tax you need to pay. After retirement, you move it into the pension phase, and then you sell it, you pay 0 tax. So absolutely, you can sell your self-managed super fund property. So after retirement, what's the cost to change the title? So first of all, we need to understand when we change in the title, what are the things involved. It can be a capital gain tax. It can be stamp duty that you need to pay, some legal cost. So what are the costs? We need to understand these costs, and then we need to find out where exactly is this property, because some tax, for example, capital gain tax is for the whole country, right? It doesn't matter where you live, you need to pay capital gain tax, and it's all the same tax rate based on your marginal tax rate. But in terms of a stamp duty, every state is different. So for example, like in New South Wales, and if we want to transfer a property, a commercial property in our own name into a self-managed super fund, it only costs about $500 nominal cost. And when you transfer out, it's the same thing. It doesn't cost you much. You don't need to pay the whole stamp duty again. So that's very cost effective. If one of the strategies, I want to buy a smaller property and then eventually I want to downsize and then move that property into my own name and live in, have the tax benefit. So that can be actually played out. Again, that comes down to why we set it up, why we buy this property, and what exactly is this strategy, how we're going to do this. And all of these are actually not a simple task. You actually need to count out how we usually do this is we need to understand what the approach is. And then we need to draft a plan. And then we need to deliver the plan to an accountant. It's like from an architecture drawing to an engineering drawing. And what the accountant would do is that accountant will bring this plan to the auditor to say, if we're going to do this, will that cause any problems? And would you be happy, satisfied if we go through this whole transaction? The auditor says, no problem, then we can go back to the beginning. The advisor can lead the whole process and then get everything done. So that's the usual process. So it's not a simple process that we can done, just with the snap of fingers. That's what it is.
Cool. Next question is there any tax benefit of SMSF investment?
Yeah, I think I'll try to answer it. This is a really big topic. Okay, you could go on forever. So with self-managed advisor, as I said, when you get to the retirement, you move into the pension stage, is zero tax. Whatever happens, it's zero tax. But there are certain conditions where you need to pay a minimum amount to yourself as a pension payment to satisfy this pension stage. Other than that, before your retirement, any income you received is taxed for 15% flat. Any capital gain hold over 12 months is 10% because you have 1/3 of the discount on capital gain tax. Also, a lot of people asked, I don't know if there's a question about negative gearing. Yes, inside self-managed super fund, you can have negative gearing. So for example, like if your super is getting, let's say 60K employer contribution to the maximum, we know all the super contribution comes in will have a 15% tax. But if there are loss happening in the fund, let's say there's a $10,000 loss, that means only that 50K will need to pay 15% tax. So you definitely have some tax benefit in there as well.
Cool. All right, so I think that's probably all about today's session. So I probably just leave to Frank and Julian to give a little bit introduction about the free consultation value can bring to all the audience and also people on site. Maybe starting from Frank first.
Yeah, so we have two codes here. The left one is you're able to lock in a meeting, 15 minutes phone call with me to discuss, if it is a good time or, what are the things that happen in your mind that you think potentially, should we do this or should we do that? We're able to have a chat. At least, we can find out what the options are available there. The second code is a SMSF full service package. So we have been running this for the past 2 years and it's been quite successful because we try to loop all the specialists into the same, same loop and build a team for our clients from the beginning to the end. So if anyone saying, look, I wanted to do this, I want to achieve this kind of outcome, then we do from the beginning to the end because we don't want to just to draw it, but we also wanted to build it. And there are detailed costs in terms of setting it up, service fees and process, everything is here in there. So if you're curious, you can always scan the code and have a look.
Cool. Julian?
From our side, our property investment assessment is really, we do it on Zoom. It's about a 45-minute meeting. Spend a lot of time understanding you, understanding your circumstances, your property, current property or property goals. We like to talk about goals because, if you don't set those goals, you're not going to achieve the end results that you're after. So, it might be, I want to earn $2,000 a week incremental revenue at retirement. So that's the goal. We need to work backwards on how we do that. Is it a couple of properties? Potentially, it could be 2 or 3 properties only is all you need to achieve that goal. We don't subscribe to buying 10 properties in 10 years and those type of marketing tactics. So for us, working through that, and then the second part of the session is really going through data, looking at case studies, looking at deals, and just understanding what would probably work best for our clients, explaining our full service, then obviously the commercial modelling and the fees associated with using a buyer's agency service.
Cool. Thank you, Julian. So I think that's all about today. And thank you everyone online, and thank you everyone. Take your time, come to the office, and we're going to have a separate session here. If you have any question, we can do like offline, communication. Thank you everyone. Bye now. Bye.
Bye.